This is Finance Spotlight, brought to you by ThinkSpace Media. Real estate investment is a popular and potentially lucrative way to grow wealth. However, it requires careful planning, research, and strategy to succeed. Which strategy fits an individual investor depends on factors like their risk tolerance, how much control they want to have over the asset, whether they are a beginner real estate investor or an expert, how much cash they have for a down payment, and what level of cash flow they are seeking. In this video, you will see the breaking down real estate investment strategies, and don't forget to subscribe, like, and share your thoughts in the comments sections. Investing in single-family rental (SFR) properties. Investing in single-family rental properties can be a solid strategy for generating steady income and building wealth over time. Fixed-rate mortgages, gradual price appreciation, and tax incentives make residential real estate a powerful engine for financial growth in the U.S. After the 2008 housing crash, both individual and institutional investors began seeing single-family homes as valuable assets. Today, these homes represent the largest asset class in real estate, valued at $4.6 trillion. In 2021, approximately $45 billion in institutional money flowed into the SFR and build-to-rent sectors. House prices generally rise over time, even though individual markets can fluctuate. Investors can leverage bank loans to purchase properties, earning rental income and capital appreciation. Rental income helps cover mortgage payments, allowing investors to build equity. Additionally, real estate acts as a hedge against inflation, making fixed mortgage payments worth less over time. Including rental properties in a diversified investment portfolio is also wise since they aren't closely tied to the stock market. House hacking is a clever way for new investors to start building equity in income-producing properties. Essentially, it involves buying a property, living in it, and renting out part of it to reduce mortgage payments or even make a profit. This passive income can be used to pay down the mortgage, make large purchases, or save for another investment property. House hacking gives investors access to residential mortgages with lower interest rates and down payments compared to investment mortgages. Flipping properties. Flipping properties means buying houses, renovating them, and selling them quickly for a profit. The goal is to buy low, make improvements, and sell high. Successful flippers find below-market rate deals, make cost-effective improvements, and sell quickly. Distressed properties can be particularly appealing if major improvements can be made affordably. Flippers need a reliable system, access to affordable materials, a skilled crew, and a good real estate agent. However, flipping comes with higher capital gains taxes if properties are sold within 2 years. Live and flip. The live and flip strategy involves living in a fixer-upper while renovating it and eventually selling it for a tax-free profit. Investors benefit from using the property while improving it, unlike traditional flippers who lose money on unsold properties. Buying below market value or making value-adding improvements can make this strategy lucrative. Live and flippers can use owner-occupied financing, often with lower interest rates. The U.S. tax code allows for tax-free gains of up to $500,000 for couples or $250,000 for individuals if the property is owned and lived in for at least 2 of the 5 years before selling. Real estate wholesaling involves acting as a middleman between buyers and sellers, earning a fee or the difference between buying and selling prices. Wholesalers find properties they believe can be sold for a profit, often by driving for dollars, using direct mail marketing, the multiple listing service, MLS, or looking for sale by owner, FSBO signs. Real estate investment trusts, REITs. REITs are like mutual funds for real estate investors. They allow individuals to invest in real estate without owning physical properties. Investors buy REIT shares, and the trust pays dividends. Established by Congress in 1960, REITs let individuals invest in large-scale, income-producing real estate. REITs pay no corporate tax on dividends paid to shareholders and offer good returns. According to the FTSE Nareit Equity REIT Index, the 40-year compounded annual return on REITs is 9.44%. Real Estate Investment Groups, REIGs. Real estate investment groups, REIGs, are private groups of investors who pool their resources and expertise to invest in real estate. Unlike REITs, REIGs are governed by private agreements, not strict government regulations. REIGs offer flexibility in structure, membership fees, and participation, making them a good choice for those who want to own a stake in physical real estate. Property tax line. Investing property tax line. Investing involves buying tax lien certificates, which are legal claims against properties with unpaid property taxes. Investors pay the tax bill and earn the right to take ownership through foreclosure or get repaid with interest when the homeowner pays back taxes. Some states allow auctioning these certificates, making it a sizable investment area. If the homeowner pays up, the lien holder gets their investment back with interest. BRR. Buy, rehab, rent, refinance, repeat. The BRR strategy involves buying a property below market value, rehabbing it, renting it out to cover the mortgage, doing a cash-out refinance, and using the profits to repeat the process. This long-term strategy is for experienced investors who can identify great deals and manage repairs. It requires knowing repair costs and timelines, renting out the property, and having good credit for refinancing. While potentially lucrative, BRR is labor-intensive and not a passive investment strategy. Rental debt snowballing is a method to pay off multiple rental properties' debts, popularized by financial author Dave Ramsey. The plan involves buying several rental properties with low-interest loans, combining savings from a job with rental income, and directing all available cash to pay off the rental property with the lowest balance. Once one mortgage is paid off, the investor uses the freed-up income to pay off the next lowest balance, and so on. This strategy offers measurable progress and flexibility, allowing investors to pause extra payments if needed. All-cash rental. The all-cash rental plan snowballs rental income for growth. However, rather than using a mortgage, you save up money and purchase a rental property, minus the debt. If you are in a high-priced market, it may be challenging to get started with all-cash investing. However, in areas that are not high-priced, this is a great option. Hard money lending. Using this strategy, you make short-term loans to investors who purchase fix-and-flip homes or rentals. Typically, the loan would involve high interest rates and lower loan-to-value (LTV) ratios. While hard money lending can be incredibly profitable, it can also come with risks. For instance, if you have to take the home back at foreclosure, you need to ensure that you are protected. BRRRR. Buy utility, rent luxury. BRRRR relies on the concept of utility cost. If a homeowner's residence would rent for more than their mortgage payment, it may make sense to live in a more utilitarian home and rent out the luxurious one. Over time, inflation tends to drive up rental income, making this strategy attractive for maximizing returns on high-end properties. Syndications, crowdfunding. This means pooling your funds with other investors to purchase real estate. It is a way to invest in any of the other strategies we already mentioned, but avoid putting the deals together yourself. In other words, you invest with general partners or syndicators that secure and manage deals for you. Crowdfunding is a newer form of syndication investing where investment opportunities are marketed through online platforms. By understanding these strategies and choosing the right ones for your goals and resources, you can navigate the real estate market with confidence and build a successful investment portfolio. This is Finance Spotlight brought to you by ThinkSpace Media. If you found this video insightful and are eager to learn more about achieving financial milestones, don't forget to subscribe to our channel, like this video, and share your thoughts in the comments section below. Together, let's start on a journey towards financial success.